Welcome back to the deep dive. Today, we're taking a really deep plunge into something that, well, it touches every single one of us. Money.
Mm-hmm.
It shapes our daily lives, our decisions, our big dreams. But look, we're not really here to talk spreadsheets or stock tickers today.
No, not primarily
We're diving into the psychology behind it all.
Exactly. And our guide for this exploration comes from Morgan Housel's fantastic book, The Psychology of Money.
Right.
The mission here, really, is to pull out these crucial insights, the ones that show why we do the things we do with money. And, how understanding that can actually be a shortcut to making better choices.
Better choices, often in surprising ways, right?
Yeah, absolutely. Housel argues pretty strongly that doing well with money, it's less about how smart you are, your IQ.
Yeah.
It's much more about how you behave, your emotional intelligence, really.
And that's such a fundamental shift, isn't it? We're always told financial success is about complex math or timing the market perfectly. But he calls it a soft skill, one we tend to ignore.
Why do you think we underestimate this behavior side so much?
Well, I think behavior is messy, isn't it? It's unpredictable, not like a neat formula.
Right.
We want that clear path. But, human emotions, they don't really follow logic charts. So Housel helps us see the real edge often comes from mastering ourselves, not just the S&P 500.
Okay, so let's kick off with this really powerful idea he starts with. No one's crazy when it comes to money.
It's a great starting point.
He gives this incredible contrast, almost unbelievable. You've got this tech genius, right? Designed a key part of Wi-Fi, super smart, ends up throwing gold coins in the ocean for fun, goes totally broke.
Wow, just wow. And then the complete opposite. Ronald Reed, humble guy, janitor, gas station attendant.
Right.
He just saved what little he could, put it in blue chip stocks, the big stable companies, and just waited. Dies with over $8 million, leaves millions to charity. It's not about who was smarter, is it? It's purely behavior.
It's absolutely behavior. And what's fascinating is how our own unique histories, our personal experiences, just completely shape our financial worldview.
How so?
Well, there's research, Malmendier and Nagel, economists, they showed people's investment habits are really anchored to what happened when they were young.
Like what?
Like if you grew up with high inflation, you're probably going to be more wary of bonds your whole life.
Right.
If stocks were booming when you were, say, 18, 20, you're more likely to favor stocks later on.
So it's not about sophisticated analysis. It's just the luck of the draw when you were born?
A lot of it is, yeah. It's the narrative you absorbed from your environment, often totally unconsciously.
That really brings it home. You think about someone like JFK. Wealthy family, obviously, but they actually made money during the Depression. So he didn't have that gut-level fear millions of others carried forever.
Right, a completely different lived reality.
Or Housel mentions the nephew of a Foxconn worker. For him, that sweatshop job, it looks like a huge step up from, say, prostitution, a perspective most of us just can't fathom. Even, people buying lottery tickets. Statistically, it seems irrational, right?
The odds are terrible.
But Housel says they're not crazy. They're paying for a dream. Something the wealthy already have that feeling of possibility, maybe.
It's a form of hope, however small. So the takeaway here for all of us listening is understanding that everyone's working from their own script, their own experiences.
Right.
It should help us judge less, maybe have a bit more empathy for others, and frankly, for ourselves too, because nobody makes money decisions just with a spreadsheet. It's all tangled up with ego, pride, fear, history.
That's a really useful lens. Okay, so beyond these personal stories, there are bigger forces, right? Almost invisible engines driving wealth.
Definitely. And maybe the biggest, most counterintuitive one is compounding.
Ah, yes, the magic of compounding. Housel uses this great analogy, the ice ages. They don't happen suddenly. It's just tiny, persistent changes. Summers are a bit cool. Snow doesn't fully melt. More builds up next winter. Repeat, repeat.
And suddenly you've got ice sheets miles thick.
Exactly. It shows how small, consistent savings, seemingly insignificant actions can just explode into huge results over long periods. But why is it so hard for us to actually do it? It seems simple.
Simple concept, but psychologically difficult. It requires patience, delayed gratification, and we're kind of hardwired for the opposite, aren't we?
Yeah, instant results.
The best real-world example, Warren Buffett. It's incredible. Housel points out something like 99.9% of Buffett's wealth came after he turned 50.
Wow, 99.9%.
And like 96% came after he was old enough for Social Security. His secret isn't just being a brilliant investor, though he is, it's his insane longevity. He's been investing for, what, 3/4 of a century.
That's staggering.
Now, compare him to Jim Simons at Renaissance Technologies.
Yeah.
Arguably a better investor year to year, right?
Yeah.
Making like 66% annually versus Buffett's 22%.
Huge difference in returns.
Yeah, but Simons is worth significantly less. Why? Because he only really hit his stride investing when he was 50. He had less than half the time for that money to compound.
So time is the real magic ingredient, not just the rate of return.
Time is the multiplier.
Yeah.
Absolutely. Good investing isn't always about the highest returns. It's about pretty good returns you can stick with for a really long time.
Which leads perfectly into this next crucial point, the difference between getting wealthy and staying wealthy.
Ah, yes. Two very different skills.
He tells the story of Jesse Livermore, the legendary trader. Made a fortune, like billions in today's money, shorting the 1929 crash.
Genius timing. Or luck. Or both.
Right. But then he got overconfident. Bigger bets, more leverage, borrowing money to invest more.
Oh.
Ended up wiped out, lost everything. It shows that massive success without knowing when to stop, without a sense of enough, can just destroy you.
It reminds me of that Joseph Heller quote, the author of Catch-22. He was at a party with a billionaire.
Yeah.
And someone points out the billionaire made more money in a day than Heller made from his famous book in its entire history.
Yeah.
And Heller just says, yes, but I have something he will never have.
What?
Enough.
Oh, that's powerful. Enough.
And that's where you see things like the man in the car paradox. You see a fancy car, you admire the car, not necessarily the person driving it. We chase wealth thinking it brings admiration, but often it just makes us invisible behind the stuff.
Right. We want the respect, not just the car.
And the never enough trap? Look at Rajat Gupta, head of McKinsey, or Bernie Madoff. Already incredibly wealthy, respected.
Yeah, beyond imagination.
But they wanted more. Risked everything, reputation, freedom for more. They had no enough. Social comparison, Housel says, it's a battle you just can't win. Someone always has more.
So enough isn't about settling for less. It's about protecting what really matters.
Exactly. It's a safeguard against life-altering regret. Your freedom, your family, your peace of mind, those are the real assets.
So it's really about survival, staying in the game. Buffett himself says his success is as much about what he didn't do.
Like what?
No huge debts, no panic selling, kept his reputation clean, didn't chase fads, didn't burn himself out. He just survived.
And survival allows longevity, which allows compounding. It all connects.
Totally. And it reminds me of Rick Guerin, who was apparently just as smart as Buffett and Munger.
Okay.
But Buffett said Rick was in a hurry, used tons of leverage, got hammered in the 73-74 crash, forced to sell everything at the bottom, wiped out. He didn't have that survival skill.
Which means the most vital part of any financial plan is planning for the plan not to go according to plan.
Expect the unexpected.
Yeah. Housel calls it having a barbelled personality. Think of a barbell weight, heavy on both ends, thin in the middle.
Okay.
You need to be optimistic, really optimistic about the long-term future. But at the same time, deeply paranoid about what could derail you right now in the short term.
Optimism and paranoia together.
That balance builds resilience. It's having that margin of safety, not to be conservative, but to make sure you survive the inevitable setbacks so you can stick around for the long-term growth.
Let's shift gears a bit to this idea of tails you win. This concept that just a few things drive most of the results.
Yeah, the power law, basically. Outliers have huge impact.
He gives the example of this art dealer, Heinz Berggruen. Fled the Nazis, later sold his art collection for like $1 billion. How? Research says he just bought vast quantities of art. Those probably weren't great, but a tiny fraction, the tail, became masterpieces. He held on long enough.
So it wasn't about picking perfectly. It was about volume and time.
That seems like it. Same with Walt Disney. His early studio made hundreds of cartoons. Most lost money. Failures, right? But then came Snow White. One massive tail success. Changed everything. Paid for all the failures, and then some.
And this plays out in the stock market too, right? Big time.
Yeah. JP Morgan Research, looking at the Russell 3000 index, that's most of the U.S. market.
Okay.
Since 1980, something like 40% of those stocks basically collapsed, lost 70%, and never recovered. 40%.
Ouch. That's a lot of losers.
But get this, just 7% of the companies drove all the index's overall positive returns. 7%. Tails.
Wow. So most stocks are mediocre or worse, and a tiny few are incredible winners.
And companies like Amazon or Netflix, they know this. They try lots of things, expect many to fail, knowing they just need a few huge hits.
They embrace the misses to find the tails.
So for us as investors, it means Maybe it's less about being right on every pick,
And more about.
how much you make when you are right and how much you lose when you're wrong. Your big wins need to cover your inevitable losses.
And how you handle those few really scary moments in the market probably matters more than all the boring years combined.
Right. Which brings us to room for error.
The margin of safety again.
Yeah, think about blackjack card counters. They know they have an edge, statistically, but they also know they need a big bankroll. Why? To survive streaks of bad luck, even with an edge, you can still lose many hands in a row.
You need buffer to withstand the variance.
Exactly. Bill Gates, early Microsoft days, insisted they always have enough cash to make payroll for a year, even with zero revenue.
Just pure survival buffer.
Buffett does the same. Massive cash reserves. Not for maximizing returns right now, but for flexibility, for survival, for weathering storms others can't.
It's insurance against the unpredictable. Like Housel mentions German tanks in WWII being stopped by, mice chewing through wiring, things you just cannot foresee.
Mice. Okay, so you need buffer for the mice. Got it.
Basically, yeah.
Now, this next one feels very personal. You'll change. And this thing called the end of history illusion.
Yeah, we're terrible at predicting our future selves.
Totally. Housel uses the example of life goals changing. A 5-year-old wants to drive a tractor. Teenager wants to be a lawyer. Mid-career parent wants flexibility over salary. Then maybe you hit 70 and realize your priorities shifted so much you didn't save enough for this version of yourself. We assume who we are now is who we'll always be.
But we constantly evolve. So how do you plan financially for a future you who might want totally different things?
Good question. What's the advice?
Avoid extreme plans. Don't go all in on some super austere savings plan you'll hate in 5 years, or blow everything now, assuming you'll earn more later. Aim for balance.
Balance promotes endurance.
Exactly. Moderate savings, okay commute, time for family, free time, things you can stick with even as you change. And, crucially, be willing to change your mind.
Like Daniel Kahneman.
Yeah, the Nobel psychologist. He apparently had no sunk costs. If a draft of his writing wasn't working, even if you spent months on it, you just scrap it and start over.
Oof, hard to do.
Very. But that psychological flexibility, not being tied to past decisions, is incredibly powerful financially, too.
That makes sense. Okay, so we need endurance, flexibility. But investing also has a cost, doesn't it? That's the nothing's free idea.
Right. There's always a price, even if it's invisible.
Housel talks about GE's former CEO, Jeff Immelt, getting tons of criticism.
Tough run for GE.
And Immelt apparently said something like, every job looks easy when you're not the one doing it, which applies perfectly to investing.
How so? What's the hidden price?
It's not just fees or commissions. The real price, Housel argues, is volatility, fear, doubt, uncertainty, and regret. That's the cost of admission for good long-term returns.
Okay. So the emotional roller coaster is the price.
Exactly. Look at the S&P 500. Huge gains over decades, right?
Yeah, overall.
But it traded below its previous all-time high 94% of the time. Netflix stock. Same story. Incredible performer. But below its peak 94% of the time between 2002 and 2018.
So most of the time, you're feeling like you're behind or down. That's the fee.
That's the fee. And many people try to avoid paying it. They sell when it gets scary, try to time the market.
And often end up paying double because they miss the rebound.
Right. So you have to accept the uncertainty as the price of admission.
Which is hard when you see other people seemingly doing great, right? This ties into you and me.
The idea that we take cues from other investors who are playing a totally different game than we are.
Precisely. Think dot-com bubble, housing bubble. You had short-term traders, momentum players pushing prices way up. Their game was quick flips. It made no sense for a long-term investor holding for retirement.
But the long-term folks felt pressured, maybe jumped in too late, or panicked when the short-term game ended.
Exactly. They weren't playing the same game, different time horizons, different goals. But we all look at the same price ticker.
So it's critical to know your game. What's your time frame? What are your goals?
Absolutely. Define your own game. Don't get swayed by someone else playing chess while you're playing checkers. It applies to spending too, right? Keeping up with the Joneses, who might be playing a completely different financial game than you.
Dangerous comparison trap. Okay, this next one is fascinating. The seduction of pessimism.
Oh, yeah. Why does bad news always sound smarter?
Right. It feels more intellectual, gets more clicks, more airtime. Housel mentions this Russian professor, Igor Panarin.
Oh.
In 2008, he predicted the U.S. would break apart into 6 pieces. Widely reported. Taken seriously.
Yeah. Didn't happen, obviously.
No. But contrast that with an equally wild, optimistic prediction someone could have made about post-WWII Japan.
What prediction?
That its economy would boom 15-fold, life expectancy would soar, it would become a tech giant. That actually did happen.
Unbelievable recovery and growth.
But if someone predicted that in 1946, they'd have been laughed out of the room. The pessimism just seems more plausible. Why is that?
It's deep-seated, I think. Evolutionarily, threats, pessimism, demanded more attention than opportunities, optimism for survival. Loss aversion is powerful.
We hate losing more than we like winning.
Exactly. Plus, bad money news feels universal. A crash affects almost everyone. And we tend to just extrapolate current bad trends, forgetting that markets and people adapt. Think peak oil fears versus fracking innovation.
Good point.
And crucially, progress is usually slow, gradual, almost invisible day to day, like tiny declines in disease rates over decades. But setbacks, they're fast, dramatic, impossible to ignore. Plane crash versus decades of improving safety.
The Wright brothers' first flight was barely noticed, but Selfridge crashing his plane later was huge news.
Perfect example. Pessimism is loud and sudden. Optimism is quiet and slow.
And this ties into the last big idea, when you'll believe anything.
Appealing fictions. The stories we tell ourselves when stakes are high and control is low.
Like that heartbreaking Yemeni folk remedy story Housel tells. A father letting someone use a burning stick on his sick son, desperate for a cure.
Believing anything out of desperation.
Or Bernie Madoff, telling sophisticated investors exactly what they wanted to hear, this story of steady, impossible returns. They wanted to believe it.
It filled a need, however fictional. Because the truth is, we all have an incomplete view of the world, right? But our brains crave a complete story.
So we fill in the gap.
We fill in the gaps, often with narratives that favor skill over luck, making us overconfident, blind to risks. It's just really hard to admit I don't know what's going to happen.
Okay, so wrapping this all together, after diving into all this psychology, what are the core actionable takeaways? What should we really hold on to?
Yeah. Okay, distilling it down. First, humility. Success involves luck. Failure involves risk. Be humble when you win, forgiving when you lose.
Got it.
Second, less ego, more wealth. Saving is the gap between your ego and your income. Keep that gap wide. Third, sleep well. Manage your money so you can sleep at night. Reasonable often beats purely rational if it brings peace of mind.
Makes sense.
Fourth, expect things to break. Become okay with stuff going wrong. Remember the power of tails. A few big wins cover many small losses.
Okay.
Fifth, use money for control. The best thing money buys is control of your time. That's the real dividend.
Love that.
Sixth, save without a goal. Just save for saving's sake. It builds flexibility for surprises.
The ultimate buffer.
Seventh, volatility is the fee, not a fine. Accept market ups and downs as the price of admission for long-term returns.
Right. Pay the fee.
Eighth, worship room for error. Build that margin of safety. Avoid financial extremes. Balance equals endurance. Define your own game. Know your time frame, your goals. Don't get sidetracked by others. At the end of the day, there's no single right way. Just what works for you helps you sleep. Housel himself prefers independence and simple index funds over complex optimization.
Wow, that's a fantastic summary. It really drives home that this financial journey, it's not just numbers, it's deeply psychological, personal, full of unexpected turns.
Absolutely. And maybe the final thought is this. In this constantly changing world, your biggest asset isn't your income or your portfolio value.
What is it then?
It might just be your flexibility, your peace of mind, the kind you get from understanding yourself, your biases, and having the humility to know you can't predict everything, embracing the surprises.
That's a really profound place to end. Thank you for joining us on this deep dive. We really hope you'll reflect on your own money stories, the game you're playing, and maybe see things a little differently now. We'll see you next time.